The loan officer told you you're approved for $500,000. You walked out of that office feeling like you'd won something. You hadn't. You'd just been handed the answer to a question you didn't ask. The bank's question was, is this loan safe for the bank? Your question was supposed to be, is this house safe for the rest of my life? Those are not the same question. They have never been the same question. And the gap between them is where most of the trouble in American household finance lives, quietly, for 30 years at a time. In the next 12 minutes, you're going to learn the actual question and the 4-minute calculation that answers it. Here's the rule that frames everything we're about to do. The math behind buying a house is almost always simpler than the people selling you. The house want you to think it is. They want you to feel like it's complicated. Complicated means you trust them. Simple means you trust yourself. We're going for simple, so we're going to throw out the bank's question and replace it with 2 better ones. Question 1. What house does your income actually support? Question 2. What income would the house you actually want require? Same formula, run in 2 directions. You're going to learn it once and use it forever. The worked example all the way through is a $500,000 home, because $500,000 sits just above the current national median and roughly tracks the home most middle-class buyers are eyeing in metros that haven't completely lost the plot. Adjust the inputs, the formula still runs. Before any income math happens, you have to know what a house actually costs per month, not the sticker price, the fully loaded monthly. There are 5 pieces, and most buyers can name 2 of them. Let's stack them on a $500,000 house, putting 10% down at this week's average 30-year fixed rate of 6.37%. That's the Freddie Mac number, pulled fresh. Loan amount, $450,000. Run that through the standard amortization formula. Principal and interest comes out to about $2,805 a month. That's piece 1. Property tax. National average effective rate sits around 0.9% of home value per year, which on a $500,000 home is $4,500 a year, $375 a month. Piece 2. Homeowners insurance, depending on your state, runs roughly $2,400 a year for a home that size on a national average, $200 a month. Piece 3. Below 20% down, your lender requires private mortgage insurance. On a $450 loan with average credit, PMI averages around 0.6% of the loan annually, about $225 a month. Piece 4, HOA, if your home has one, is piece 5, and it varies so wildly we'll leave it at 0 for the example. But if your dream house has an HOA, add it. Add it up. $2,805 plus $375 plus $200 plus $225, $3,605 a month. That is what a $500,000 home actually costs you in 2026, with 10% down at this week's rates. Not the principal and interest number the calculator on the listing site shows you. The real number. Memorize the gap. The listing site number is 22% lighter than the truth. That's the gap that swallows people who didn't run the full stack. Now here's where the buyer's protection comes in, and you've probably heard the name without anyone explaining what it actually is. It's called the 28-36 rule. The front-end number, 28, says your fully loaded housing payment shouldn't exceed 28% of your gross monthly income. The back-end number, 36, says all your debt payments combined, housing, plus car, plus student loans, plus minimum credit card payments, shouldn't exceed 36%. That's it. That's the whole rule. Here's the part nobody tells you. This isn't the bank's rule. The bank will lend you well past these numbers. The Federal Qualified Mortgage Standard lets banks approve loans at a debt-to-income ratio of 43%, and government-backed programs go higher. So the bank's idea of approved is structurally bigger than the buyer's idea of actually fine. The 28-36 rule was never about the loan. It was about the rest of your life. It's the cash flow buffer that protects the dishwasher repair, the kids' braces, the car that suddenly needs a new transmission in March. Approved is not the same as affordable. Approved is the bank's answer. Affordable is yours. Use the rule. Now let's run the formula in the first direction. What house does your current income afford? 5 steps. Step 1. Take your gross monthly income. That's pre-tax, the top line on your pay stub. Step 2. Multiply by 0.28. That's your safe monthly housing budget. Step 3. Subtract your estimated property tax plus insurance plus PMI for the price range you're shopping in. What's left is your principal and interest budget. Step 4. Take that P&I number and back-solve the loan amount it supports at today's rate. Step 5. Add your realistic down payment. That's the home price your income supports today. Let's run it 3 times. A household earning $90,000 a year. 90 divided by 12 is $7,500 a month. Times 28% is $2,100. Subtract about $450 in taxes, insurance, and PMI for a home in that price range, and you're left with $1,650 for principal and interest. At 6.37% over 30 years, $1,650 in P&I supports a loan of about $265,000. Add a 10% down payment, and you're looking at a home price of right around $290,000. That's what 90 grand actually buys you in 2026. Not the $500,000 dream house, a $290,000 real house. Same math at $130,000. Income divided by 12 is 10,833. Times 28 is just over $3,000. After taxes, insurance, and PMI, your P&I capacity is around $2,250. That supports a loan of about $360,000, plus a 10% down. A home around $400,000. $130,000 a year buys you a $400,000 house. Not the median anymore. Below the median, one more. $180,000 a year. $15,000 a month times 28 is $4,200 for housing. After tax, insurance, PMI for that price tier, your P&I is roughly $3,400, supporting a loan around $550,000, plus 10% down, putting you at a home price right around $610,000. There it is. To buy meaningfully above the national median in 2026 with a normal down payment, you need a household income that pushes past 150 grand. That's not opinion. That's just what the formula returns. Congratulations, you now own the formula. Let's run it the other way. What income does the house you actually want require? Same 5 steps, reverse direction. Step 1, start with the target price. We're using $500,000. Step 2, subtract your realistic down payment. Let's say 10%, so $50,000 down, $450,000 loan. Step 3, calculate principal and interest at today's rate. We already did that, $2,805 a month. Step 4, add property tax, insurance, and PMI. Total monthly housing, $3,605. Step 5, divide by 0.28. $3,605 divided by 0.28 is $12,875 a month. Multiply by 12, and the gross annual income required is about $154,500. Compare that to the Census Bureau's most recent median household income, $83,730. The required income for the median home is roughly 1.8 times the median income. The median household is not the buyer of the median home anymore. That's not a slogan. That's just the arithmetic of where wages, prices, and rates currently sit. It isn't a verdict on you. It's information. The market changed faster than incomes did. The formula just makes that visible. Quick reality check. No rule fits every life. The 28-36 rule assumes you live in roughly the way average Americans live, with average expenses and average everything else. If you live cheap by choice, you can push past it. If your healthcare costs are unusual, if you support extended family, if your industry is volatile, you'd be wise to pull back from it. Run the formula honestly against the life you actually live, not the life on the cover of the magazine. The math is the floor, not the ceiling. So you ran the formula, and your current income doesn't support the house you want. 3 honest paths close the gap. They are levers, not life advice. Pick the ones that fit your real life. Lever 1, the income side. Raise your gross household income. Career move, second earner re-entering the workforce. Side income that becomes serious income. Going from $110,000 to $154,000 closes the $500,000 gap. That's a 40% raise. It's hard, and it usually takes years. And most career move advice that promises faster is selling something. But the math is real. 40 grand in additional gross household income at this rate environment moves you from priced out to priced in on the median home. Lever 2, the down payment side. A bigger down payment shrinks the loan, shrinks the principal and interest. And once you cross the 20% line, PMI disappears entirely. Same $500,000 house, 20% down instead of 10. Loan drops from $450 to $400. P&I drops from $2805 to about $2494. PMI gone. Total fully loaded payment falls from $3605 to about $30,069. Divide by 28%, the required gross income drops to about $10,960 a month, $131,500 a year. You just shaved $23,000 of required annual income off the same house by writing a bigger check at closing. The down payment is the most underrated lever in this entire calculation. Most coverage talks about it as a barrier. It's also a tool. Lever 3, the price side. The cheapest path to affordability is buying less house. Move the price from $500,000 to $400,000. Same 10% down, same rate, and your fully loaded monthly drops from $3605 to roughly $2,900. Required income falls to about $124,000 a year. You just dropped the required income by $30,000 by adjusting the address. Geographic arbitrage, smaller square footage, different metro, slightly older home. Same family, same job, different math. The structural reason median buyers can't buy median homes isn't a moral failure. It's a price tag problem. Sometimes the solution is the price tag. Most people fixate on lever 1 because it feels like the only one that doesn't require a compromise. The other two are usually faster. The other two are usually the answer. So, what do you walk away with? 2 formulas you now own. Run direction 1 when you want to know what house your current paycheck supports. Run direction 2 when you want to know what paycheck your target house requires. Both run on the same 28% rule, the same fully loaded payment, the same current rate environment, and the same 6th grade arithmetic. The number the bank approves you for is not the number the math says you can afford. The 28-36 rule is yours, not theirs. It's the buffer that keeps the rest of your life functional when something breaks. And in any house, something always breaks. The best financial decision is the one you understand. Now, go make yours.